Hello, today is Wednesday, May 26, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Willms, and I am the President and CEO of the Milwaukee Company. Joining me once again this morning is Jake Willms, who is a quantitative analyst with the Milwaukee Company. Today, Jake and I will be discussing China's looming corporate debt crisis and its potential impact on the markets. We will also discuss China's efforts to rein in commodity prices and the latest developments surrounding the ongoing crypto sell-off. Before we get started, please keep in mind that this podcast is for informational purposes only, and that the views expressed in today's podcast are Jake and my personal views and not those of the Milwaukee Company. Welcome, Jake.
Hey, thanks for having me back again.
Well, it's always a pleasure. Jake, let's get started by discussing China's concerns about the amount of corporate debt that is coming due in China.
Yeah, this was a really interesting thing that I found when researching some topics to talk about. As of May 23rd, so 2 days ago, China has 1.3 trillion in domestic corporate debt coming due in the upcoming 12 months. Even with the context of the pandemic and global credit hike going on, this is still a massive number. To put it in perspective, that's enough to buy the Tesla company twice. And it's more than what 30% of US companies owe. It's huge, huge number.
Yeah.
The maturity wall is beginning to worry investors as defaults begin to surge at an unprecedented pace in China. And with so much money due back in the next year, questions are mounting for how the country will handle it and what's going to happen to markets abroad.
Okay, so you're saying China's corporate debt is greater than that of, like, for example, U.S. and Europe?
Oh yeah, yep. I think the numbers are the U.S. is about $1 trillion, so we're China's $300 billion over, and Europe has only 800 billion, so it's much higher than Europe.
And so, what about how the duration or the maturity of these bonds?
Well, I think that's actually more important than even just the raw number in some cases, because the duration is moving in the opposite direction to the two that we just talked about. The US and Europe, their corporate bond average maturity has increased, but China is actually getting shorter. If we take a look at how it's moved since, say, like 2016, where the average maturity was 3.8 years, we're all the way down to 3.02 years now.
Oh, that's quite a shortening. What's led to this shortening of the average maturity of China's corporate debt?
Well, I guess it's hard to point it to exactly one or two things, but best guess from what I found is that there's been a rise in defaults on the corporate debt, and that has pushed the institutional investors to scale back the amount of debt they're willing to take on and favoring shorter term bonds to protect themselves from default risk.
Oh, I see what you're saying. The shorter term bonds will come due more quickly, and the idea is then you're more likely to stay out of harm's way. Whereas if you have a 7 or 10 year debt with a corporation and problems arise anywhere in that long period of time, then you could be stuck holding the bag if the corporation defaults.
Yeah, exactly. And it's something that you're going to have default risk no matter where you're going to be getting your bond from. But with the trend that's happening in China, that's equally as powerful as to maybe what else is other factors that may be at play, because after all, we're human and we're going to be responding to that, as humans would do. I also think that it's something to mention that institutional investors aren't just favoring shorter term bonds and investing the same in China. They're actually rotating out of investing in China altogether. And that is a big problem for them, because if the institutional investors aren't pushing the narrative for those longer term investments and the high amounts, then it's going to hurt them in trying to stabilize their bond market for sure.
Right. So I guess if you're a U.S. investor, a listener to this podcast, and you are you like to invest in Chinese corporate debt for a variety of reasons. And one of the most important is, of course, there's diversification. Another might be, protecting against a falling dollar. There's a lot of good reasons why you might want to do that. But you have to be much more careful about the quality of the underlying debt and that you're investing in. You probably want to stay away from junk bonds in China, low-rated Chinese debt, and try and focus on stronger, well-established companies that have good revenues and a long history. Does that make sense?
Yeah, I would agree with that for sure. Something also
Okay.
that's going to affect U.S. investors is that if institutional and even just normal investors are rotating out of China in favor for the likes of, say, the US and Europe, then that increased demand is going to be keeping the rates low because there's more people willing to buy and they're not going to be needing to raise rates as quickly. Bond
So
prices
rates,
are
you
staying
mean
high.
rates on US, you mean the rates on US and Chinese, US and European debt will be kept lower than they would have been because that money's being redirected
Right,
uh,
exactly.
to US and European bonds. I get it. Um, and I suppose, it could go even further because, there's been this concern about commodity prices, and we all have heard about that. And I suppose if you have Chinese corporations struggling with debt obligations, then they won't be purchasing as much commodities, which could lower demand and perhaps help mitigate some of the commodity price hikes we've seen lately. Um, I don't know if you're aware of this. I'm sure you probably are, that in addition to fighting this corporate bond problem, China has also stepped up its fight against uh, soaring commodity prices. Um,
Hmm.
they're really trying to rein in, the price of metals, because that, if the price of metals soars too high and other commodities, it's going to obviously have a negative impact on China's industrial complex, which is you know based on manufacturing, and of course the cost of materials goes into a big part of that. Um, so, in other words, what I'm saying is, a surge in commodity prices could provide more fuel for the fears we talked about last week of rising inflation, which in turn could have, a negative impact on economic growth and the markets outside of China as well as inside of China. What do you think?
Yeah, I think that the concerns about Chinese markets are impacting just more than just a bond. There's concerns with the commodities markets. There's concerns with even in crypto because China's been cracking down there. So it's really there's a lot of uncertainty there, and it's not going to remain domestic either. Big changes are going to affect globally. So it's very important to keep on top of.
Yeah, and you mentioned crypto. I'm glad you did, because have you been watching what's been going on in the crypto markets lately? I'm
Oh,
sure you have.
it's
That,
unbelievable. I mean,
that
I don't think
that's a
I've
big
ever seen a
decision.
sell off like this. It's just everybody's abandoning. It's ridiculous. But just like a couple weeks ago, we're looking at a Bitcoin over $60,000, a coin, and
Right.
it's not even close to that now. It's at like 37,000, something like that, 38.
Yeah, I think it was down 50% at one point, and I think Ethereum was the other big competitor.
Ethereum, yeah, Ethereum's down
Ethereum,
even
thank you.
worse.
I just Ethereum, thank you. Wasn't that down big time too?
Yeah, I think that one is down even worse,
Yeah.
down closer to 60%.
So when was the last time we saw anything like this? Wasn't it like back in March of
Yeah, I
2020?
mean, well, the pandemic wasn't even that bad though. They did drop down just like everything else, but I don't think it was this bad. This is the first time I've seen like a humongous liquidation where people are actually just getting out.
Yeah, I know there was a huge sell-off last week. I think what was it, like around $12 billion of cryptocurrency sold. And I saw somewhere that since April 17th, there's been more than 42 billion of crypto leveraged long cryptocurrency liquidated, meaning that effectively people who had borrowed on margin to buy crypto had a margin call as prices fell, which forced resulted in forced selling of the crypto that was collateral for the margin call.
Wow. Yeah, I didn't really consider that, but imagine how many people bought cryptocurrency, on margin and were just relying on it to continue rising because there's no issue if the price is going to keep going up, then there's no issue in leverage purchases like that because you're not going to be required to make that margin call like you just mentioned. But as soon as it starts going down, the whole thing is going to fall apart. It's like pulling a card out of a stack of cards in like a big triangle and just start
Yeah,
pulling a couple
house of
down at the bottom,
cards, pull one
and then the
out.
whole
Yeah.
house is going to come down.
Well, even more so than that, you could, a lot of investors who had a margin call, who people investors in crypto might, a lot of them also invest in stocks and and equities and that sort of
Mhm.
thing, and tech stocks. And if they get a margin call, it's not only the crypto they have to sell. If the crypto isn't worth enough to cover the margin debt, then they're going to have to sell stocks too, right? To cover the difference, which is obviously a drag on the performance of stocks and in particular tech stocks. So, and I think there's another sort of behind the scenes cause, and that is you see a lot of people who uh, own crypto pledge it as collateral for loans that they've taken out, right? There's this whole crypto lending market. Companies like BlockFi and Celsius and others will allow Bitcoin holders to pledge their cryptocurrency as collateral for loans. But what happens is if the value of the crypto falls below the certain point, then the lender's going to again sell the crypto just like it was on margin. And again, they don't have to do it with the permission of the borrower.
Yeah, I mean that makes sense, right? Because the lender wants to make sure that their collateral is has some value, so they have to set a threshold for where at some point they have to be able to get U.S. dollars out of it.
Right. And so I guess, all these, when crypto was first, the idea behind crypto was, of course, that it would be an alternative to government backed currencies. It would be currency that didn't require governmental support. But it seems to me, and you might feel differently, but it seems to me that these wild price fluctuations mean that it's really not viable as a form of money at this point. And just like a little simple example, if we say the cost of a Tesla is 4 Bitcoins today, and then it goes to only 2 tomorrow, people won't be using it to buy a car because they won't know what the car is costing them, right? And so so in my opinion, at least for the time being, investing in cryptocurrency should be regarded as speculation, more akin to a wager than a long-term investment or as a store of value. Right now, it's just a way to try and make money on where the market short-term swings in the value of Bitcoin. And that's the definition of speculation in my mind. What do you think?
Well, I agree in part. I think that current behavior with cryptocurrency is speculative by nature, but I don't necessarily agree that that will be its long-term use. I think that the main reason right now that people are buying it in that speculative nature with the goals of just churning a return and have no interest in spending it as a currency is because, for one, the US dollar and other government-backed securities are not securities, sorry, government-backed currencies
Currency.
are sufficient. And there isn't really a big enough reason to opt for Bitcoin minus the use in illegal activities, but that's a
Yeah,
tiny number.
that's what I was going to say. Well, that's exactly right, though. That is where it's being used most being used as a currency, right?
Yeah, online transactions or illegal activity. However, that isn't necessarily going to be the long-term use either. And the question raises for an investment standpoint is how does that play in to your portfolio if you're trying to own cryptocurrency? Is it something that you want to own? Is it something you don't want to own at all? Or how does it reflect in that kind of a setting, and that's the hard thing to answer because
Well,
of the amount of volatility and risk it has.
right. Well, let me just say, first of all, I'm not saying cryptocurrency, crypto won't ever be uh, used as a legitimate currency. I'm just saying that it can't serve as a currency right now because its investment fluctuates so greatly. All
Yeah,
right.
I think that
And
I don't
then
think many people would disagree with that for sure. It's just the way it's
so
been behaving.
so right now, the reason you would buy it would be driven the motivation to buy cryptocurrency would be driven more by speculation than as a long-term investment vehicle. But I'm not saying speculation is a bad thing. I mean, we often talk about speculation as it's somehow some kind of inappropriate way to invest. And the fact of the matter is, speculation is a perfectly fine way to invest for people who are willing to assume the risk that comes along with speculation, right?
It is the best way to get those big returns is to take on the speculative risk and to really just put your foot down on one particular thing. You're not going to
But
get nearly the type of return in S&P buying,
the problem with speculation, though, Jake, as a way to generate return, is sure it can lead to great returns, but the hard part is keeping it. Right?
Yeah.
Most speculation leads to quick money, which oftentimes results in much quick losses too. I mean, history is littered with example of even well before. I mean, going back for all the time, all of market time, where you've had many people who made a lot of money in speculation, whether it be on gold, railroads, airport. I mean, you can go on and on and on. And the problem is, once you've made the money, getting out and doing something, quitting when you're ahead, I guess, is the problem. Most, or not most, but many speculators find it very hard to quit when they're ahead. And it's that human nature, that part of our human nature that, in my mind, makes speculation for most of us a bad investment strategy. But if you're one of the lucky few who can control those control your human nature and quit when you're ahead, then hey, more power to you. So, but for me, I'm not much for speculation. Hell, I'm not even much for gambling. All right. Well, on that note, Jake, I think we can wrap it up. Let me thank you and our audience too for joining us. And I'd also like to remind our audience that they should conduct their own independent research before acting on any information or opinions that Jake and I have expressed during this podcast. And tell them that you should not act on anything you've heard in this podcast until you've discussed it with a qualified financial professional who is familiar with your personal situation and your investment objectives. Thanks once again, and have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.